presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compact Market Wrap YouTube update for March the 31st, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. First of all, don't forget to subscribe to this channel. Click on that button so whenever I post an update, you will be notified and you can watch it at your convenience. Looking at the numbers, markets continue to slide. We had a midweek market went up, but end of last week they came right back down. The S&P gave up 1.52% on the week. The Dow was up 0.96 or down 0.96, S&P down 1.52. NASDAQ continues to be down 2.59. This morning we opened much lower. I'm doing this midday on Monday. Markets are reversing up, so we could see a reversal day up. What that means, I'll explain in a minute when we take a look at the charts. But that could be a good sign, and if we can get a weekly reversal, that could mark a turnaround in the market. But tomorrow, the markets right now are terrified of the tariffs. That's really what it is. What is it going to be? Tomorrow is supposed to be Liberation Day or Tariffs Day, whatever you want to call it. We're going to find out exactly what the tariffs are, how much they're going to impact, and everybody is at this point starting to calculate what it is going to do to prices. 25% on cars. Car prices go up by 25% or whatever price they will go up by. It'll push up insurance costs. It'll push up costs, and that somebody has to pay for that. Either companies absorb it, where they take all these increases and do not pass them on to the consumer, which I don't think they'll be able to do. But if they do that, it'll eat in profits. When the companies don't make profits, their stocks do not go up. On the other hand, if they do increase prices, then the consumer has to pay for it. And the consumer, at this point, is in good shape overall. They don't have a lot of debt as far as corporations go. Most of the debt is on the government. That's what we've seen. The debt increases on the government side, not on the corporate side. So what are the ramifications of this? We're getting first quarter GDP estimates, which are around 0.3%, less than 1%. 1% is stall speed for the economy. That means if we are not growing at 1% GDP growth, that means we're not creating jobs, and that'll start showing up as higher unemployment. And unemployment usually is the last thing that starts to go up. By the time unemployment goes up, usually we're headed or already in a recession. So right now there's a lot of uncertainty. Technically we're oversold. Technically it looks like we're trying to make a bottom, but the overwhelming market news, it's just the headline macro news, tariff news, that is really upsetting the markets. And will that overpower the technicals and we continue to move lower, or we make a bottom, it'll all depend on what the tariffs are, how they impact the markets, and what we'll have to see. So we'll have to wait and see how that turns out tomorrow. Consumer staples were up last week, 1.7% for the week. Technology was the worst sector, down 3.7% for the week. S&P now is down about 5% for the year. Again, 14% is the average decline we see from the high point down to the lows on a normal year. That's how much volatility we see. We haven't seen that last couple of years. Markets have gone straight up, so we've sort of become accustomed to that. But we're starting to see the same kind of volatility. We are down about 10% from the highs. Oil was down last week quite a bit. Interest rates about the same, not much change there, from 4.25 to 4.27. So interest rates are holding steady, and that is another problem. The Fed will have a tough time lowering interest rates, trying to support the economy if prices are going up, if inflation is going up, because you can't cut interest rates while inflation is going up. So if you cut interest rates, inflation goes up even more. And that is called stagflation, where we have a stagnant economy and we are seeing prices going up at the same time. And that is usually very difficult to control once we get into that sort of cycle. Again, a lot will depend on how these tariffs come out and how much they impact the economy overall. Again, defensive positions, defense spending is starting to go up dramatically. You can see that The Germany is expected to increase its defense spending quite a bit. UK is also increasing its, and we're seeing that all across Europe. What are the long-term implications of this while the U.S. Defense spending is coming down? What are the long-term implications of this? Either, again, I talked about this 20 years ago. Are we going to decouple from China? We've seen that decoupling, and now that is accelerating, where factories are moving out of China, companies are not moving their factories to China. Are we going to see this decoupling from Europe over the next 5 to 10 years? If that happens, Europe will go its own way. It might decide that, you know what, we are paying a huge tariff to do business in the United States. China might come along and say, look, you can do business with us, and we don't have to pay, you don't have to pay these tariffs. Will that happen? Right now, Europe is dependent on the U.S. for defense, but if they don't have to depend on the U.S. for defense, they build their own defense industry, they build their own over the next 5 years, then they might say, maybe we should, decouple from the United States. And that, in the long term, could be a very big problem for the U.S. In the short term, it might be okay, but in the long term, it could be a problem. And that is something that we have to think about over the next 5 to 10 years, not in the short term, but we'll have to wait and see how all of this sort of settles out. PCE fell 0.3% month over month, year over year. That's the inflation gauge that the Fed watches very carefully, 2.5% year over year. Consumer confidence fell in March. PMI composite rose. So we're getting a mixed picture right now on the economy, but I think we are going to see this week we get the unemployment number for March later on this week. We'll have to wait and see how that turns out. And we're not seeing unemployment really go up. The claims for unemployment benefits have not moved up, even with all the federal layoffs that we've seen over the last couple of months. This week we get the big number is going to be the payroll number. Private payrolls expected to be up by 130,000 jobs created. Last month we saw 140,000 jobs created. So we have slowed down from the 250,000 jobs created every month or so. We'll have to wait and see. Unemployment rate is expected to remain stable at 4.1%. That is the number. But if unemployment starts to go up, I think that will get everybody pretty concerned that the economy is slowing down and starting to slow down dramatically. Looking at the technicals, we came and made a new low. We got below the low that we made here in earlier on this month. We took out those lows this morning, but now we're positive on the market, slightly higher for the S&P as I do this broadcast about midday on Monday. If we can close positive here and get above the 200-day, which is 57.60, we were here for a couple of days, then we broke back down. Now we're coming back up. We'll have to wait and see. If this is a fourth wave, this could be 3, and this could be 5. And that could be the end of the move to the downside. If we can get above 57.60, but we'll have to wait. We are at 55.86 this morning, so we have to wait and get above that. But the first sign, we went below Friday's low, and we're closing. If we can close positive today, that will be a daily reversal where the market goes below the previous day's low and it closes above the previous day's close. Now, if you get this on a weekly basis, where we go below last week's low and then close positive, that would be a good sign. We can close above 56.74, which is the 50-week moving average. That would be a very good sign, but we'll have to wait and see if that happens or not. This week is going to be a pivotal week in the market. Either we are going to make a short-term bottom and start rallying from here, or we start to break down and start to move further down to the downside. On a daily basis, major support is down somewhere right around here, which are these lows from September of last year, around 5,400. That's the low, and if we break below 5,400, then we're looking at this low right here, which is the August low, right around 5150 or so, or 5125 or so, about here. We'll have to wait and see if we can get some more rally here. If this is only a fourth wave rally here, then we just go back and forth for a little bit until we move down again. So this week is going to be, I think, pivotal to mark a short-term bottom or a bottom in the market. Looking at the NASDAQ, again, we went below Friday's low, but we are positive right now. We can get a daily reversal And then on Friday, if we get a weekly reversal, that would be positive. Weekly reversal mean a lot more than daily reversals in the market. NASDAQ still negative on the day. 18.1 is the number that I'm watching. We're at 17.2 this morning. So we have to go up about 1,000 points. But if we can get above 18.1 or 18.2, 18,200, that would be the first positive sign for me in that market. Yields today are up, bouncing right along here around 4.22, which is the 200-day average. That's this line right here, the 200-day. We're at 4.25 today, just right along the 200-day average for the yield. Small caps bouncing off the 200-day, 200-week moving average, around 200. We're at about 199.38 today. Again, small caps, not particularly excited about those. We have to go really move up to the upside before I get excited. Gold is making a new high today. It gapped up. Here's this gap. These lines do not overlap, so that's called a gap in the charts. I believe this could be an exhaustion gap. If the stock market makes a short-term bottom, starts rallying from here, it could also mark a top in the gold market where people are not as anxious. If the stock market starts to go up, they won't run to gold. But gold is having a big day on the upside, up about $40 on the day, pushing around 31.50 this morning. So we'll see if this gap is an exhaustion gap, where the market exhausts itself, comes back down, fills this gap. 3,000 is going to be the number I'll be watching on the gold market. Again, don't forget to subscribe to this channel. Again, whenever, just click on the subscribe button whenever I do an update, you will be notified. And don't forget to listen to the podcast. It's a much more detailed view of what I just talked about. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.